It's been a reasonably good start to financial markets in 2012, but what we are dealing with are a number of changes to some of the underlying themes that are driving markets. For once, Europe appears to be off the top of the agenda. Certainly the stresses that were seen in bond markets during the course of the latter part of 2011 for the moment seem to have subsided, and we'll talk a little bit more about that. But secondly, we're seeing possibly a higher incidence of corporate earnings coming through that are missing expectations, but despite that, equity prices seem to be forging ahead, taking its cue really more from the resolution or hopeful resolution in the Greek situation in the forthcoming future, in the near future. So if we take a look at the FTSE 100 chart, we can see here that the FTSE 100 has been finding some resistance up until now around the 5,720 level. But it managed to break through that level and push on into 5,737 by the mid part of the week. And if we just take a look at one sector that has for the moment come back into favour, this is the banking sector. This chart's a little bit complicated, but we have three of the UK banks here, and we're looking at the comparative performance, particularly here if we focus from the sort of right-hand side of the chart to how they've performed in the early part of this year. And we're registering gains of between 20 and 30% in our major banks. This is consistent with what's going on in Europe as well. And what appears to have taken place is that in December, you may recall that a scheme was put into place by the ECB to allow many of the banks in Europe to lodge a wider range of assets against that in return for 3-year money at cheap rates, i.e. 1%. And that money appears to be making good use into the bond auctions that have taken place at the sovereign level. So this week we've seen further bond auctions from Italy, from France and from some of the other regions, including Portugal, where there are some stresses in the system. And it means that those bond auctions generally are perceived to have gone quite well. As a result of that, that has allowed what I call the risk assets to move higher. So the banking industry is the highest of those risk assets in terms of equities, and of course that's why it is the bigger story at the moment. Now, whilst these shorter-term considerations are welcome, that we don't have some of the sort of worst fears that were held in 2011, that we would struggle to refinance, struggling to refinance some of these sovereign auctions, what we do have to respect is that a lot of the new issue paper that is coming out is relatively short-term paper. So whilst, say, let's take a country like Italy, has current maturity of about 7 years to its debt profile, with all of the issuance of this new paper, it does mean that gradually the maturity is going to come tighter. What that does mean is that we're still refinancing this paper at too higher rates, and that the problem in 2 or 3 years' time is going to come round again unless these countries can seek to get more growth out of their economy. Interestingly, the Prime Minister of Italy, Mario Monti, was in London this week talking about the reforms that he's taken place in Italy, certainly within 2 months of his leadership. And I think he's made some pretty big steps towards getting the country onto a good fiscal move, and was speaking quite encouragingly. So at least Italy does appear to be in the hands of an excellent leader at the moment, who knows what needs to be done to try and bring that country back on track. If we take a look just at how this is all playing out in the currency markets, the euro-dollar, euro has taken a bounce. It's taken heart from these auction moves at the moment. There are record levels of short selling in the euro at the moment, as hedge fund managers are betting against the euro at the moment. When you get such a large volume of short selling in the market, it's invariably going to be subject to squeeze higher, as there's either short covering or forced short covering, which results in these sort of big moves in the dollar. So the trend is still certainly down for the euro. I wouldn't necessarily call this the turning point of the euro at the moment, but this sort of squeeze that we've seen at the moment is that some of the sort of bears of the euro, who were probably thinking that the auctions would have struggled more than they have, are having to close positions in the near term. So there is a chance of a sort of bigger bounce in the euro short term, albeit that we can still see the trend is coming down. Now, turning to some of the corporate earnings, I mentioned that we are seeing a higher incidence of profit warnings. And it's evident as we stand today that 44 of the US top 500 companies have reported quarterly earnings. Now, if we talk about the last set of earnings, most companies were beating expectations, but this time around, out of 44 companies, 15 have failed to beat on their earnings per share expectations. Indeed, they've disappointed. 28 so far have exceeded. So we're getting a much better sort of balance between those performing well and those that are beginning to underperform. What I find interesting is that the share price reactions of those that miss expectations can be quite harsh. And overnight we heard that Google missed expectations and their stock traded down about 10%. So whilst markets are going higher, I think the concern over potential landmines over businesses that are beginning to feel the squeeze and issuing profit warnings is that there's much more volatility in individual charts. I'm going to mention whenever there is a problem, what impact it's having. If we take a look at one chart that of a company that's been in the news this week for the wrong reason is Carnival Corporation, which owns the boat that was sunk in Italy, and you can see there the price reaction as that company looks like it's going to be taking at least a $95 million hit onto its expectations. But I think there will be an overhaul of safety within the entire fleet, and that is going to, I think, raise the cost of their of this issue to that company. Another business that struggled is Essar Energy. It's one of these new breed of businesses that find themselves in the FTSE 100, but it's a company servicing the Indian energy, steel and oil markets, and they suddenly found that a supreme ruling on tax could potentially cost them 1.2 billion of deferred tax, and of course that's been probably one of the worst performing FTSE stocks over the course of the last year. And one to keep an eye on for me is BSkyB, due to report second quarter results on the end of January, and I'm just interested to see that this company started this year down about 8% relative to a market that's up 3%. So it's very unusual for Sky to suffer such a large relative underperformance at the moment, and it's just begging the question as to whether the developments in the technology space at the moment is beginning to undermine the Sky platform at the moment. So one analyst calling for real need for Sky to put out some strategic statements towards the end of this month. So some pressure coming on the shares.